Hi, it's a beautiful day here in Colorado with a touch of spring in the air, and I'm starting to see those for sale signs go up in the neighborhood. And if you've been thinking about selling this year, here are some home seller tips for the day when you receive an offer, or maybe even more than one offer, on your home. And a question you probably haven't even thought about will pop up: whether to accept or reject an offer. Because it might not be just about the money. Other than a buyer's offering price, here are some important things that you might want to consider before deciding whether to accept or reject that offer that you just received on your home. Number one would be earnest money. Now, earnest money is the amount of money that the buyer puts down with their offer. This is separate from their down payment monies. It's separate from their loan money. It's simply showing you, the seller, that they are serious or earnest about the offer that they're giving you. It's the money that they're putting at risk. And here in Colorado, that amount is anywhere from 1% to 3% of the sale price. Or it could be even higher than that, depending upon the buyer's wish to express their intent to purchase your home. Here in the Denver metro area, earnest money is held by the title company. And then that money is credited back to the buyer as part of their down payment monies at the closing table. The pros of a high earnest money, of course, you really get to see how serious the buyer is about buying your home. Because should they back out of the contract for no good reason, you, the seller, the potential to keep that earnest money. Of course, the cons now are, here in Colorado, the way the contracts are written, there's a lot of ways for a buyer to walk away from a contract, starting with the inspection period. And a good buyer's agent is going to do everything in their power to make sure they're protecting the buyer's earnest money throughout the contract. Now, number two would be contingencies that are part of the contract to buy and sell, especially here in Colorado. Now, contingencies are something in the offer that you're going to want to pay attention to. And of course, they usually start with home inspections. And this is where the buyer will bring in their inspector, and they're going to look at all the systems in your home. They're going to look at your HVAC system, your plumbing system. They're going to look at the roof. They're going to look at the foundation. They're going to look at how the appliances function. Number one, they're looking to see what the home has to offer. And two, they're looking for any health and safety issues that the house might have that the buyer needs to know about. And the buyer may want these addressed before they buy the home. So the pros of a home inspection are obviously that the buyer gets to check under the hood of your house, and they become very aware of what it is that they're purchasing. This time, the buyer could request that the seller have something either repaired or replaced if it isn't functioning safely. You as a seller now have another chance to do some negotiation about what you will and won't do. Of course, the cons of a home inspection is we see a lot of deals either fall apart because the buyer and seller can't come to an agreement, or the buyer finds something in the home that they can't live with and they walk away. This is usually where the buyer can get out of the deal and they don't even have to give the seller a reason. Appraisals would be next. The appraiser is sent out by the lender to appraise the property. The listing agent will usually meet the appraiser, have them tour the home, and then show them how you and the listing agent came up with the sale price for your home. An appraisal is needed for any buyer who's getting a loan to purchase the home. The lender wants to make sure that the appraisal or the value of the home matches what the buyer is willing to pay for it, so that the lender will loan them the amount of money for that purchase. This way, should the buyer default on their payments, the lender knows that they can put the home on the market and sell it to get their money back. So the pros, obviously, of getting an appraisal are going to be the fact that, number one, you open the door to a lot more buyers, because there are only going to be a small pool of buyers that have cash to buy your house. And if your agent and you have done your research and priced the home correctly, there should be no problem with your appraisal. Also, this means that the buyer is going to get the money they need to buy your home. So barring anything unforeseen, like the buyer losing their job or something like that, you're pretty much in the home stretch of going to closing once the appraisal has passed. Now, of course, the cons would be, what happens if the home doesn't appraise at what the buyer said they're willing to give you? Could come in lower. This could cause the contract to fail because we all know the lender isn't going to give more money than what the home's valued at. Or it could mean that you have to renegotiate the price with the buyer if you still want to sell. However, before you ever get to this point in the contract, because appraisals are usually, they're like 3 weeks in, there's something you could be looking at initially when you first get that offer, and that's called appraisal gap coverage. Now, appraisal gap coverage is something that started coming up over the last few years. With our very low inventory here in Colorado, high buyer demand, and remember those low rates that were occurring at the time? Yeah, what would happen is a lot of bidding wars on the homes that were for sale. If you've ever been to an auction, you know that bidding starts driving up the price on an item, and that's exactly what was going on with our homes for sale. A seller would list a home at, say, $525,000, and then the bidding would start. And in the end, the seller might accept an offer at $550,000. The seller would love that higher price, and then the appraisal would come in for the buyer. but maybe the appraisal would only be $525,000. Initially, that's where a lot of deals would fall apart because the seller really liked that higher price and the buyer really liked the lower price. The deal would fail if the seller would not lower their price. With a bunch of people in line for the home, sometimes they didn't have to. The way for a buyer really wanted the house in a bidding war would be to write in the contract an appraisal gap coverage. That's where they would guarantee the seller that they would bring to the closing table in cash the difference between the appraised value and their offer if the appraised value was lower than their offer. The pros with this, obviously, for the seller with appraisal gap coverage is that literally they're guaranteed that the buyer's going to buy the home at the price they agreed upon. Cons, of course, we really eliminated anybody that didn't have the extra cash to cover the difference, which meant a lot of our first-time home buyers were struggling, and this is where part of the challenge with home affordability came into play. Now, 5 would be financing, and financing has its own contingencies, and these vary. And these deal with the type of property you have and the financing that can go with that property, as well as having dates in the offer to protect the buyer in case the lender doesn't approve their mortgage or make some kind of change to the mortgage that the buyer was not expecting. Now, most single-family houses can do it all. They can go cash, they can go conventional, they can go FHA, VA, which are government-backed loan products, or they can do a 1031 exchange, which is an investor strategy. There's really no problem unless the home is like a serious fix-up or a scrape, where they may only be able to do either cash or conventional financing. And you're looking then to attract an investor. If you live in a townhome or condo community, you may need to check with the HOA to see if you can go FHA or VA, because those loans, which are government-backed, relate to what percentage of your community is owner-occupied, where people actually live in the home, or where investors own and there's a bunch of rentals. Both those loan products have rules around that. So now that lenders are licensed, just like realtors, they're required to make sure that the original cost quote to the buyer stays within a certain percentage range to protect the buyer from sudden changes in what they expect to pay for a home. If you're looking through your offer and you have a single-family house, the pros are the more different financing options you can offer the public, the more the public will get to see your home, and that will get you the best offer. Cons, of course, would be that either you have to limit your buyer pool because of the type of loan that's available to go on your home. Again, restricts how many people can actually make you an offer or even get to see your home. My name's Peggy Dursthoff with Live Denver Suburbs, powered by HomeSmart. And as you can see, when it gets to that offer, a lot goes into it, even more than I mentioned here, where you and your trusted agent can look through the paperwork and see that the offer has everything in it that works for you, not just the price, before you decide whether to accept or reject that buyer's offer. If you're wondering if now is the right time to sell your home or buy a home, go ahead and check out this video over here. Talk about just that. Thank you so much for watching, and if I can help, please reach out. And in the meantime, I'll see you in the next video.